Okay, so good morning, everyone, and welcome to the macro snapshot, the new week. We are Monday, March the 10th, 2025. Just a quick technical issue. Having a lot of issues with the internet seems to be incredibly slow. So hopefully the charts will work. They're a little bit sticky between transitions, so I'll do my best and let's hope things work. Okay, guys, so I think the main thing we need to be looking at to start with is what's been happening over Europe. We all know the announcements of a huge fiscal sort of spending and deficit spending by the Germans. But really what's going to be interesting is to see just also the politics of that. But let's just look at a few charts. Just want to put this in perspective here. So we have a weekly chart. So this is on the German yield. So this is the 1 year yield. And you can see that not really much happened last week. And if we go in the 2 year yield, we see that we did get some upward movement. But really, when you start looking at the fives, and then the tens, and then in the 30s, you see like a huge upward movement again on this is the weekly for the German yields. And this makes sense because basically with these higher sort of deficits, what we're going to get globally is higher sort of deficit spending. So therefore, the global competition to fund all these deficits is going to sort of start heating up, which ordinarily should put upward pressure on these yields and should steepen the yield curve, especially in Europe. So that's like a sort of a key fundamental shift which we saw in the markets. Last week. We also saw last week that the ECB cut once, but now there's a lot of debate as to whether they will in fact just pause in April or maybe cut or not cut at all. And so it's looking though we're starting to get some real sort of battles sort of heating up in Europe in terms of what's going ahead. The other more general thing is that now that the Germans have decided just to sort of spend like drunken sailors on shore leave, as they say, it's going to be very difficult to have any of those sort of 2010 style austerity packages pushed onto countries like sort of, Spain or Greece. You remember the incredible pain that, let's say, the Greek economy went through 10, 15 years ago with these austerity measures. And basically the Northern Europeans telling the Southern Europeans to sort of pull in their belts and, sort of tighten everything and stop spending because they were spending too much. That's going to be very, very difficult now politically, now that the Germans have decided to spend, almost a trillion euros on infrastructure and defense. So kind of interesting just to watch all the politics of that. But let's just get back to the situation here. The problem here is that inflation in Europe is, let's say, at about 2%. So maybe 2.25, 2.5, but let's call it about 2% because Lagarde last week was pretty confident that that was coming down. The problem here, if we look at some of these yields, is that the real yields are incredibly low. So if you look at, let's say, the 2 year, or the Schatz, it's 2.2%. So let's say inflation is around about 2 or 2.2%. Technically, what we have here is a real yield of zero. If we go out to, let's say, the 5, you can see that's trading at about 2.45, so a real yield of 10 or 20 basis points. If you go to the tens, where a lot of this deficit spending is going to be, that's about 2.8%. So again, if we look at the inflation rate as 2.2, you're talking a real yield for the deficit spending on the tens of about 60 basis points in Germany, and on the 30s of about, about 80 basis points. And historically, that's just not enough. Market participants will want to be rewarded for this deficit spending with a real yield of greater than 20, 30, 40 basis points. So the nominal yields in Europe, but particularly in Germany, need to go up, and the curve will definitely need to steepen. So basically, these real yields would definitely need to rise, and that's something which I think we're going to see over the next sort of period, maybe the next 3 or 6 months. And I'll get to the politics in a little bit because we just had an interesting headline, which is going to sort of be indicative and illustrative of some of the challenges ahead. But let's say we look at the 2 year yield. And again, this is a weekly chart. So on these kind of big historical moves, it's good to get a little bit of perspective. But on the 2 year, I think, we could easily get up to about, 2.45 or 2.5. So I think this is where we are now. And I think definitely we've got a little bit more space. You see up to here, let's call it 244, 245. And I think that's where it's going to be going. On the 5 year, similar kind of sort of upside. I think this could definitely get up a little bit more to these kind of levels, maybe about 2.75 or so. And to be honest, anytime the yields dip over in Germany, let's say, for example, it goes down to, I don't know, down here or something, 238, 240 or so. Anytime those yields dip, I think maybe you want to be sort of buying some puts, maybe you want to be shorting sort of the bonds. So that's definitely the situation. Anytime the price rallies or the yield goes down, you want to maybe be shorting that price or buying the yield because that looks as though it's going to go up. The 10-year, again, I think that could go up a lot higher. And then again, if we even put it on something even longer term, let's say, for example, out on the monthly to really zoom out here, and just to give everyone a little bit of perspective, yes, German yields can go up a lot further. We had negative yields for quite a long time, and we got used to this idea that in Europe, yields are always sort of at 0 or 50 basis points, but definitely they can go higher. And if we look at the monthlies, we might even be able to get something like around about this level here, about 3.5, and even push up a little bit more, 3.65, 3.70, something like that. And that would give us at that point, it doesn't seem too extreme because even if we get up to 3% or let's say 3.5%, that's still just a real yield of maybe 1.5%. So that's the difference investors are collecting in premium over the rate of inflation. So it's not too kind of extreme. The other thing as well, and again, we'll just get back maybe to the dailies here. It's just looking at some of these yield curves. We've already seen quite a lot of steepening in Germany. If you look at the if you look at the curve, um, oops, sorry, that's the wrong one. That's the US. I was just thinking that looked a bit odd. So let me just find the German curve here. Yeah, I think that's completely flattening. So yeah, as you can see here, the twos, tens, that's already started to steepen. But remember that a normal kind of deficit funding level will be much closer to, let's say, about 1.6. Or 1.8. So the point is here, at this point, we're only got between the twos and the tens, got about 60 basis points. So I think the point is here that, this can go and probably needs to go a lot higher if Germans do want indeed, I'll put it on the weeklies, they do indeed want to sort of go ahead with this spending. So we see here, I'd say the next steps, probably around about 0.86, 0.87. But to be honest, I think there's no reason why that can't go up a little bit more, even to, let's say, about 1.3 or so. So definitely, anytime this curve flattens, you want to be buying the dip. The other thing as well, if we look at, let's say, the fives to the tens in Germany, just to have a little bit of perspective here, again, that's been steepening. But again, I think that can get definitely the next stop up to, let's say, 70 basis points, 71, which is up here, and then maybe even a bit further up to sort of 90 and then up to 96. So definitely, I think it's going to go up to these kind of levels, which we haven't seen for about 4 years, going back to 2021. So again, this idea that the curve needs to steepen, and it should always, the difference between the front end and the back end should be like 1.5%. And then just in terms of the nominal yields, they need to go up more because the real yields at this point are very low, 20, 30 basis points. And that's just not going to entice investors, especially as around the world we're starting to get more deficit spending. Now, you could argue that in the US, there's potentially a little less deficit spending for sure if Doge comes in and cuts and whatnot, but that still remains to be seen, and also the magnitude remains to be seen. So the thing to keep in mind is that there's going to be more global competition for deficit spending. And so it's going to be difficult really to see also in terms of the US to see the long duration yields coming down too much. Because the point is that if in Europe and Germany the yields are going up, we're seeing in Japan that the nominal yields are going up. It's going to be kind of difficult to imagine that in the US suddenly they're going to collapse. Now, could there be a differential? Yeah, a relative spread that may tighten. But what would really get those longer yields in the US has to be a substantial reduction in deficit spending and also a real slowdown in the US, the economy. So let's just look at some of the differentials, which is kind of interesting. So if we look at between Germany and the US. So this is the US 2-year subtract the German 2-year. And again, if we look at the weeklies here, this has come in a lot in favor of, well, I don't want to say in favor, but let's say it's come a lot closer. So it was about 2.4. It's now come down to about 1.75. So that's come down, what's that, about 65, 70 basis points or so. But this still is still relatively elevated. It's still 175 basis points of differentials. And the point is that if Europe is reflating and trying to go into kind of heavy deficit spending and a growth pattern, and if the US is in some kind of slowing down, even if it's just like a moderate slowdown, then the differentials can be reduced. And let's say probably the next stop is down to, let's say, this 1.4 level, and then even you got to say 1%. And who knows over time? I mean, it's not extraordinary to think that it might not get down to even kind of sort of lower levels. So definitely, this is something which has more downside. And if you look historically, just want to put this into perspective because it looks as though it's moved a long way. But definitely no problem to go down to 112 basis points. Probably next stop would be 80 basis points. And then, it could even get down to, something like 35 over time. And again, there's a lot of things which need to happen. It would have to have a reduction in the deficit in the US, an economic slowdown in the US, and we would have to see that all of this deficit spending actually was being spent over in Europe. But just to put that in perspective, these differentials can definitely come down. And then just quickly, if we look at something like the 10s, again, just putting it on a weekly, you can see that, yes, it's come down a lot, but it's potentially could get even down to, maybe the 10, what's this, 10, 110, 105 kind of level. And then eventually over time, which could take, 6 months or something, it could even get down to maybe sort of even a lower level, something like this, down to about 1. So a little bit more room potentially to move in those spreads as well. Okay, so if we get back to the US, what's happening in the US? The US yield curve is steepening. But there's not really a lot of action in the front end. So again, if I just actually find the US yields, so let's look at the US and have a look and see what's been going on. Again, this is a weekly chart just to have a bit of perspective. You see in the US, not a huge amount happened last week. If we go on the 5-year, how's my charts here? 5-year going up a little bit more, the 10-year a bit more, and the 30-year a little bit more. So what we're seeing here is a gentle steepening in the US, not a huge amount of action at the front end. And basically what's happening is that I think traders are sort of buying in preference the US treasuries, especially the front end, and selling the German long end basically. And what we can see also, if we look at, let's say, something like the Bollinger Bands, just have a little bit of see what's going on here. We can see that we'll go on the 10-year. We can see that, the Bollinger Bands are slowly starting to contract a lot, and there's not a huge amount more of kind of downside in the US yields. So I think what's going to happen is that German yields in general will tend to trend upwards. US yields, especially at the front end, are not going to be doing a huge amount. And we're going to see a little bit of contraction volatility, and probably most of the volatility will be either at the long end of the US curve or in Germany. And the reason I'm saying that not a huge amount in the front end of the curve, we look at something like Powell, who was speaking on Friday afternoon, and just got a quote here. This is what Powell said on Friday, and we have to keep this in mind. He said, "We are in no hurry and are well placed to wait for greater clarity. So if the economy remains strong, but inflation does not continue to move sustainably towards 2% target, we can maintain the restriction for longer." So basically saying, hey, if the economy remains fairly robust, we're simply not going to do anything. On the other hand, if the labor market were to weaken unexpectedly or inflation fell more rapidly than anticipated, we can loosen the monetary policy. So basically what Powell is saying is that we're going to do nothing at all for the next meeting, probably the next meeting or two. They need more clarity on what's happening with the Trump tariffs and also the data. We're going to be data dependent. Now we have the CPI and the PPI this week, but to be honest, I don't know how market moving they're going to be, maybe a little bit of short-term volatility. But the reality is, I think, the market is comfortable at this point with this sort of narrative that inflation is, not super high, not super low, relatively sticky, but not at an alarming level. Let's call it, 2.25, 2.5, 2.75, and the real issue here is really the Trump tariffs or not, and whether the economy and the employment market is weakening or not. So I think that's really the situation here. I mean, if we just go back to some of the charts here, let's say we'll look at the 5-year, which is a good indication of where the market thinks the real economy is going. We can see here that at the moment it's trading at 4.02, and keep in mind the general collateral and the Fed funds rate is about 4.33. So you're still getting less for this, if you're invested in this, than the Fed funds rate. So I think, probably there's not a huge amount of downside, even if we get slightly lower than expected inflation. And I think that these 5-year yield can probably drift up a little bit, maybe in a trading range up to 4.3 or so, which would be, as I say, where the Fed funds is and general collateral. So it can go up here a little bit, maybe about 20, 25 basis points. And as I say, the Fed is not cutting anytime soon and is definitely in a waiting mode. So the thing is as well, if we just have a quick look at, let's look at a couple of other sort of charts. I want to look here at the term premium, which I think I put up here. Let's have a look. Oops, very slow here on the terminal, the Bloomberg connection. Not great, sorry guys. But if we look here at, this is the real yield as well. So we see that the real yields have been coming down in the US. And if we look here, if it can go, it's a bit sticky here, the term premium, I think I clicked on that. Let's have a look. Anyway, the term premium, oh, here we go. Oh my God. Okay, we see the term premium has been coming down. So we have the real yields coming down in the US, and we have the term premium coming down. And that's because the nominal yields have been coming down and inflation's drifting just down a tiny bit as well. And that's probably a little bit also because of this fear about a slowdown in growth. Also, the fact that the market thinks because of DOGE, the Department of Government Efficiency, there's got to be more job losses. But I don't think that can come down too much more. And also, I think possibly it's going to stabilize here because as sort of traders understand that the competition for deficit spending is going to heat up around the world. I think that's going to create more sort of basically higher sort of yields. Okay, let's have a look now at FX markets to see what's going on. Obviously, a huge move last week in the euro. Let's just bring up the chart here. So I might just look at the dollar index here, which as we know is 58% in the basket composed of the euro. Sorry, the chart's a little bit slow. Doing my best. But if we look at that, I'm just going to put it on some exponential moving averages here, some EMAs. What we can see here is that it's obviously came a huge way down last week. Again, this is on a kind of a weekly chart. But I think what we're looking at here is that, there's probably some support a little bit lower, let's say on the 200-week moving average down here. And again, I'll put it on the dailies. Maybe we're getting to some kind of consolidation here and certainly maybe a little bit lower. I don't know that can go too much lower here, to be absolutely honest. But I think what we might get is a bit of consolidation this week. But eventually, if we're getting these higher real yields in Europe, we're getting a reflation in Europe, we're getting more growth in Europe and a bit more of a slowdown in the US. Could we see any kind of bounce being sold even down to parity by the middle or the end of the year, down to 100 level? I think so. But at that level, it's probably going to be pretty stable. If we look at the euro, obviously a huge move upwards over the last 3 or 4, 5 days. But what you guys can see, it's quite overbought just from a technical perspective here. I think it definitely might find a little bit of overhead resistance at this sort of 109 level, or even, let's say 110. Maybe up here, 110.60, something like that. A little bit more to go. But, to be honest, if we go back and look at the weeklies, we can see that, it tested here the 200-day moving average on the weekly. So maybe just a little bit of consolidation here. But I think the idea here is that this is a buy on dip. This is definitely going to be a buy on dip. Having said that, if the differentials come in, maybe what that's going to tell us, if we look at the differentials between the US and Germany, is that could be a case then of buying some US treasuries and selling the bonds. I think that's the way to be looking at it. So keep an eye on those differentials as a kind of a way to be thinking when you could be selling the euro or buying the euro, and the same for the German bonds. It's something pretty interesting. Okay, so we go back on the dailies here. Let's just have a look at gold, which is kind of interesting. Not a huge amount of action in the gold priced in US dollars. If we go here on the spot, let's bring it up. And as you guys can see, in the last 4 or 5 days, just drifting, just kind of in a sideways down a little bit consolidation. But if we actually put that in priced in euros, I think we can get it here in euros. Let's have a look. I don't know what happened, just disconnected. Sorry, guys, weird internet gremlins here. Euro. Let's see. So what we can see here, look at that. You see the big difference here. Priced in euro, gold actually had a pretty dramatic sort of sell-off last week. So maybe here, looking at this, we've got maybe support here a little bit further down, maybe 2,600, something like that, 2,550. Let's see what that looks like. Something down here. So I think, this is kind of an interesting level here, 25.87 priced in euros. And that makes sense because, the real yields in Europe, remember we saw the real yields are going higher and need to go higher. And therefore that will make gold priced in euros less attractive. Now, we haven't seen such a big move in the US, of course. That's my point, is that gold priced in euros really has to deal with those increasing real yields. But in just sort of regular, let's say, US dollars terms, as you see, we don't see much of a move at all. So the point is here that the gold is still quite supported. It's still a good buy on the dip, but maybe something like 2750 could be, a pretty interesting level. And looking at this level down here, 27, maybe 2800, something like that in US dollars, I think could be the level. Looking at about 2800 here on the spot, kind of interesting. Just in terms of commodities, if we just look at a broad index, something like the GSG, let's have a look at it. So this is a broad index, quite a lot of energy in here. Again, it's been drifting down a little bit, and it's getting down towards the low end of its trading range. I don't know that it's going to particularly sort of collapse through there. But something like 2070, if it does go down a little bit more, like just goes down here, like say 2070 or to 2120, sort of in this range down here. So let's say 2070 to 2120, that would be kind of an interesting kind of buy zone here, I have to say. But definitely at this point, gold is still relatively outperforming the commodities, and oil is still pretty stuck. If we look at oil, which I've got here somewhere, where's oil? Let's just have a look at the oil chart. Oh, starting to stick up again. Sorry. Let's see if this loads up. Yep. So if we look at oil, having a little bit of a bounce, but this is just a long-term sort of upward trend line down here. It bounced about 65.60. Nothing much we can say here, because the point is, guys, that if we look here at a fib retracement here, this is not even like a 38% fib retracement. So pretty weak price action. And realistically, I just want to do a better fib retracement here. If we look at any sort of impulse, we're going on the most recent impulse, we're just at the 38%. But as soon as we start pulling back those fibs, you can see, and we go all the way back here, it's still got a lot of work to do. So the bulls have a lot of work to do. All of the moving averages of turning down and over there. So at this point, probably a little bit of dead money. I mean, if you get to some crazy levels down here, probably, intraday, not a bad little sort of technical bounce back there. There's some talk about more US sanctions on Iran and Russia, but at this point, I think the market is taking it posturing, and there doesn't seem to be a lot of money flow there. Just finally, let's look at some of the equities. I'm just going to have a look over at Europe as well. If we look here at let's say actually we'll look at the index here. So we see here that the European index, the Euro Stocks index here, going pretty much sideways, finding it difficult to push above. And that's just because, for sure, all the moving averages moving upwards. It's still in an uptrend. The momentum is still there, but definitely the momentum is softening in Europe. And if we look at Germany on the DAX, on the futures here, even a little bit of negativity. And part of that, I think, is just this political issues that the German, we just got some headlines coming across about an hour ago, which I think are up here, that you can see Germany's Greens won't support draft debt package in Parliament. So that came in at 7 o'clock. And basically, this is what I was trying to say before, is that the incoming coalition, which is not even officially yet a coalition in Germany, they were saying, yeah, we're going to spend 400 million here, billion and 400 billion on defense and infrastructure, and the provinces, the states in Germany will get, another 100 billion each, and the debt break, this constitutionally mandated kind of fiscal discipline, they would, get rid of that. Okay, and that sounded good. And that's why we saw the Bund yields ripping last week, and the Bund selling off, and the euro going up, and the euro stocks going up. But the reality is that in order to get the debt break change, which is to have more fiscal looseness, that requires a change to the constitution, which requires a 2/3 majority, not 50%, two-thirds majority, and that's difficult because we don't even have a full majority in the incoming German parliament. So what they're trying to do is to push it through quickly, which I find deeply undemocratic. But anyway, they're trying to push it through in the old parliament, the Bundestag, and they only have until March the 24th, which is 2 weeks. So they're trying to do this incredibly complex package and push it through with fractious sort of coalition partners. And what's interesting is that some commentators, and it's a little bit my belief, is that yes, they'll probably get it through, but there could be some quite significant compromises and maybe not as much spending, not as easy. And already we're starting to see a few cracks here. The Greens won't support the debt draft. So it's going to be very interesting to see if we do start to see a little bit of, just on this uncertainty, a little bit of weakness in the German stock market, the European stocks. Maybe the Bund gets a little bit of relief. I'm not going to say a huge rally. And generally some of those German yields come down, which of course could put yields down a little bit elsewhere. So that's going to be interesting, the internal politics there of Germany. But just getting back to the stocks, let's look at the cash index, the SPX. And this is pretty interesting here because we can see here that, if something like 5670, which is down here, absolutely key level here, horizontal support, sort of hanging around like the 200-day sort of EMA, absolutely sort of key support here. Now, the thing is, I'm not expecting the US equities to collapse because the economy still seems to be relatively strong. We're still seeing the employment market seems to be relatively strong. Powell's not going to be hiking. Okay, he's not cutting. Earnings seem to be okay. So I think the best we could probably hope for here is some kind of range trading. And I do believe that this 5670 on the cash index is a pretty key. And the other thing to keep in mind, and maybe pushing up, I personally think that the 5880 level, something up here, is a pretty good level maybe to be shorting. So I do believe we're going to be trading somewhere in that range. And the other thing to keep in mind, looking a bit bigger picture, if indeed there is some stimulus coming out of China, and we can talk about that later this week, if there is some stimulus coming out of China and a lot of stimulus coming out of the Eurozone, and the Eurozone is reflating, is that not at the periphery good for the global economy, and possibly even that makes the probability of the US going into recession actually less, right? Because remember, for example, a lot of this defense spending, a lot of that money is not immediately or totally going to be going to European defense contractors. We know there's quite a big defense sort of sector in, let's say, Sweden and also in Germany and Italy. There's a bunch of companies. But from what I've been reading, a lot of the earlier defense contracts, a lot of that money will also flow backwards to the US. So my point is that I don't know that there's an immediate sort of fear that the US stock market will absolutely collapse. On the other hand, there's certainly a lot of reasons why it won't rally. We know the Trump tariffs, and they do seem to be, over the weekend, we had Trump not ruling out the possibility of recession. And he said on the interview yesterday, I think it was with Fox News, he said 5 or 6 times, he said that there was going to be some short-term pain. So both Trump and Bessent at the Treasury are reiterating this message and being very clear that there's going to be a period of readjustment, there's going to be a period of some pain, there's going to be short-term sort of dislocations. And really what they seem to be trying to set the market up for and the public is to say, hey, we are really trying to rebalance or reconfigure global trading. We are trying to onshore sort of manufacturing back into the US, and that could cause a little bit of short-term pain in the US stock market and maybe even in the employment situation. But Trump seems to be telling people, if we take him at his word, and certainly Bessent, that is sort of part of the plan. They expect that. And they hope to have, the US economy growing strongly, let's say at the end of 25 and maybe into 2026. So that's kind of interesting. If we look at the NDX, which is the cash index here, we can see that 1990 is a 19,900 is a pretty good support level. You see here, there's quite a lot of support. And could that range up to, let's say, again, up to here, 20,700, something like that could be like a pretty good level there. So I think, really probably what we're going to see this week is just, both the S&P 500 and the NASDAQ just ranging in those kind of ranges there. What could be interesting and something we're going to be keeping my eye on is actually emerging markets. If we have a look here, because if we continue to maybe have some kind of sort of structural weakness in the US dollar, could emerging markets sort of just, get a little bit of a bid here and sort of push up? Because at the minimum, if those countries which, fund their debt in US dollars, with a weaker dollar, they will have to be paying back less US dollars, which, is a positive for those economies. And so kind of interesting maybe here to be thinking about a long in EEM, or maybe even, selling some puts if you exercise, maybe down here at something like, I don't know, something like 42.50 or 42 could be an interesting strike price in theory to be selling some puts, because I think that could be a pretty good support level there. So just finally, guys, just want to have a quick check-in with volatility. Again, volatility has remained pretty elevated. Looking at the VIX, so you see even this morning pushing up to 26 and a quarter, which is high, and that will make it difficult for the stock market to rally substantially. And if we just look at the curve, just to finish off here, we can look at the volatility curve. It looks like my internet's getting a bit better. And so you can see here, this is where we are at the spot price now, the live price. You see here, we're trading up, as we just saw, at, let's see on the Bloomberg, at 26. And if we go a day ago, it was lower, and even still lower a week ago. So if we get rid of those, we go there. And what's interesting, as I would like to know, we see here that the spot is above the first month in the futures contract, and the first futures contract is above the second and the third and the fourth, the fifth, and the sixth months, which is quite unusual. So that a very strong backwardation in the VIX futures curve is a sign of elevated market risks and sort of, I don't want to say fear, but let's say elevated market sort of nervousness. And so we could be in for sort of more volatile conditions today, and potentially that would be a headwind for the stocks rallying significantly. Again, that's one of the reasons I think it's just probably going to be in this sort of trade range for this week. So just to do a summary here, I think what we're thinking of is, in terms of Europe, probably like the big trades, the trades which are sort of make the most logical sense is to be buying any dips in Eurozone equities. So, in some shape or form, I think that the stimulus will get through in Germany. It could be modified. There could be certain concessions to the Green Party. But at the end of the day, I think one needs to be looking to be buying dips in the Euro stocks or maybe the German market. Probably also in the Euro, if that comes down 100 or 200 ticks, 1 or 2%, buying dips in the Euro. Probably also the yen. We didn't really speak about it much, but buying dips in the yen, especially against some of the weaker cross currencies, is probably a good idea. I think the curves in general are going to be steepening globally, but specifically in Europe and Germany. So any kind of flattener, you want to be buying the dip to be buying the flattener. And then in terms of the US, I do believe if we get to elevated levels, maybe that 5880, 5900 level in the ES, for example, you want to be sort of selling rallies, just because, inflation remains sticky, the Fed remains on hold, and Trump has basically told us, along with Besson, as I just said, that they are trying to cut spending, cut the deficit. And so you do have this sort of dislocation between what the Americans are trying to cut spending in the deficit and the fiscal stimulus, and the exact opposite in Europe. So definitely there could be some outperformance there of European stocks over the American stocks. And finally, probably in the US as well, maybe even at the front end especially, maybe buying dips, any significant dip, and let's say the 2-year or the 5-year, or even some of the SOFR contracts, maybe Z25, like December 25 or June 26 might even be better. Something like June 26, so M26, if there's a significant dip, could be a reasonable one. Okay, thanks, guys, for your patience. Sorry, I was a bit later this morning. Tried to do an overview with the sticky Wi-Fi. Seems to be a bit better now. Have a great week. We have CPI, we have PPI. And of course, we have a new Prime Minister of Canada, which I didn't talk about much. We have Mark Carney, who's known as a technocrat. Of course, he used to be the head of the Bank of Canada, but also the Bank of England, so a very serious person, respected by the markets. Already this morning, he's come out with a bit of sort of pro-Canada nationalist rhetoric, which is probably a little bit more political, basically saying that they're going to sort of, Canada will sort of push back on any imposition of tariffs by the Trump administration. We shall see. Let's see how that develops over the next few days. I think I've spoken enough. Take care. Have a great week. Thank you.